I think Friday turned a lot of people who may have gotten bullish on gold in the last couple of weeks bearish. And that's probably exactly what the Chinese want, right? If the Chinese started this sell-off just by announcing a 1-month hiatus from buying gold, that was enough to get the new buyers to throw in the towel. Well, now that's more gold for the Chinese to buy. And they got a lot of gold that they need to buy. So many people that maybe just bought into the market in the last week or two who are now gone, right? And just thrown up their hands in disgust. Who knows where they're going to come back in? I mean, maybe gold will have to be well above 2,500. Silver might have to be 35 or 40 before some of the people who just bought.
At the end of May, China held 72.80 million troy ounces of gold, unchanged from April. However, the value of China's gold reserves rose to $170.96 billion from $167.96 billion over the same period. American stockbroker PeterSchiff shared insights into recent shifts in gold prices, noting that no significant economic data was at play. Schiff attributed the sell-off to China's announcement of a 1-month hiatus from gold purchases in May, which prompted traders to quickly sell their holdings. China's central bank paused its gold purchases in May, ending an 18-month streak of consecutive buying, just as spot gold prices hit a record high. This official data release on Friday caused spot gold prices to fall by 1.4% to $2,342 per ounce. The rally in gold prices from March to May, driven by safe haven demand amid geopolitical and economic uncertainty, took spot prices to a record $2,449.189 per ounce on May 20th. Despite this, Schiff views the situation as bullish because gold reached a new all-time high in May without Chinese buying. He predicts that China will use this market dip to acquire more gold, especially considering the stronger-than-expected non-farm payroll numbers, which also contributed to the drop in gold prices. Traders are focusing on May's non-farm payrolls report, with estimates suggesting the addition of 185,000 jobs to the workforce, up from April's 175,000. The unemployment rate is expected to remain at 3.9%, and average hourly earnings are projected to stay unchanged at 3.9%. Gold prices are experiencing a notable decline ahead of the U.S. non-farm payrolls report at 12:30 Greenwich Mean Time, primarily due to traders' profit-taking and position squaring. Now, we present clips of PeterSchiff's insights. Before we continue, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
I woke up on Friday morning and I saw gold down $40. I had no idea why it would be down, especially in front of a jobs report. Normally you wouldn't see that because people would be worried. What if it was a weak number? Right? People would not want to sell gold in front of that number. Normally, if there's a $40 move in gold on a jobs day, it's in reaction to the number. Right? The number has come out and it's not what was expected, and so there's a bigger move in the markets as they kind of readjust to the new data. But gold was already down $40. The market hadn't even opened. And so I wanted to know why. So I go online, I do a little research, and I see the news out of China that China had announced that during the month of May, they didn't buy any gold. At least officially, they said they didn't buy any gold. They had bought gold for 18 months in a row, and in the month of May, they didn't buy any. Apparently, this is bad news. When the traders learned this, they immediately sold gold. Oh my God, China stopped buying. I mean, it's 1 month. So what? I mean, as far as I'm concerned, that's a bullish announcement, I think, because if gold made a record high Friday, or in May rather, without the Chinese buying anything, to me, that's pretty bullish because normally the Chinese have been buying, and even without the Chinese. Now, of course, when I say the Chinese, I mean the government. Obviously, Chinese people, the people themselves, didn't stop buying gold. I'm sure they bought plenty of gold. The government didn't buy any gold for that month. But even without the government buying gold, gold made a new all-time record high without China helping. So to me, that's actually bullish that gold didn't even need Chinese buying, and it still made a record high. But the way the markets reacted to this announcement was like, oh my God, that's it. China's done buying. Why would they be done buying? They didn't buy gold for 18 months to stop now. This is just the beginning. They got a lot of gold to buy. Does it make sense that they backed off a little bit? Like all of a sudden, gold is breaking out to a new record high. Maybe the Chinese were like, okay, let's pause a bit. Maybe we'll get a little bit of a pullback. We've bought for 18 months in a row, and now the market's kind of running away. Let's take a step back. Let's see what happens. Maybe we could get a little bit of a pullback, which ironically, they got based on announcing that they didn't buy. The markets have just given China a gift, not only because the market fell $40 on the news that China didn't buy any gold in May, giving them the opportunity to buy more gold now in June. But then we got the non-farm payroll numbers that came out later in the day that were stronger than expected, and that sent gold down another $30. So down $70 on the day. And so if the Chinese didn't think down $40 was a bargain, I'm sure they're buying tonight. I'm doing this podcast on Sunday night. I'm sure that the Chinese government is going to be backing up the truck and buying into this decline. They're probably laughing about it, about how foolish Americans are or Europeans to give them this gift and to react to this little news announcement. They'll probably keep this up their sleeves for some future announcements when they want to buy more gold. Put out a news announcement like this so they can convince foolish Americans to sell them their gold at a lower price. And in fact, when they announced the fact that they didn't buy any gold, they were also announcing other economic data that evening. One piece of data that came out was their trade surplus, which swelled. The Chinese trade surplus is kind of the mirror image of America's trade deficit, and our trade deficit really shot up.
In the interview, PeterSchiff delves into the recent rate cuts initiated by both the Bank of Canada and the European Central Bank, highlighting their favorable implications for gold. Schiff suggests that these moves signify a broader trend wherein central banks globally are resigning from their efforts to combat inflation, foreseeing further rate reductions as inevitable. Notably, the Bank of Canada reduced its overnight rate from 5.00% to 4.75% on Wednesday, followed by the European Central Bank, which cut its main refinancing rate by 0.25% to 4.25% on Thursday, spurred by lower inflation figures in Switzerland. There's also mounting speculation that the Swiss National Bank might follow suit and slash its key rate during its upcoming decision on June 20th. These actions propelled spot gold to $2,387 on Friday, its highest level since May 22nd. However, the metal faced a downturn following a robust U.S. non-farm payroll report. Schiff argues that these maneuvers by central banks contradict their rhetoric of targeting a 2% inflation rate, suggesting a lack of genuine commitment to this goal. Let's return to the interview for further insights.
Talking about the rate cuts, so we got rate cuts from the Bank of Canada and the ECB. All of this is bullish for gold. I mean, in a way, you could say it's supportive of the dollar, which would, in theory, create a headwind from gold. But as far as I'm concerned, it's bullish for gold. Gold has been rallying without the dollar being weak, right? The dollar index still around 104, 105, been trading in that area. It's really been going sideways for the last year or two. And during that period, gold keeps making new highs. So it's not about dollar weakness relative to the euro or the yen. I mean, the dollar has been strong relative to those currencies, or stable. All those currencies have been weak. Gold hits record highs in every currency. And the fact that the ECB and the Bank of Canada are already throwing in the towel on the inflation fight. I mean, as far as I'm concerned, they threw in the towel when they stopped hiking. But now they started cutting. And they're not going to stop, right? I mean, these are just the first of several rate cuts that are going to follow. It's not going to be one cut and then they're going to start hiking again. They've already committed to cutting rates. And so the question is, when are they going to cut again? The Fed, of course, hasn't cut yet, but it's a foregone conclusion that they're going to cut. So the only question is, how soon do they cut? Not, are they going to raise rates? So all this is bullish. None of these central banks is going to do what it takes to bring inflation back down to 2%. They're just not admitting that yet. So they're all trying to pretend that they still have a 2% inflation target and that they're committed to hitting that target. But at the same time, they're easing, they're cutting rates, or they're talking about cutting rates. So their rhetoric, their deeds don't match their rhetoric. They're talking the talk, but they're not walking the walk. And so pay attention to what they're doing, not what they're saying. So if they're trying to misdirect you with their rhetoric and they're talking about how we're committed to lower inflation on the one hand, but then they're cutting rates, even though inflation is not anywhere near 2%. Now, what are they saying? Well, we just assume that inflation is going to keep falling, and so we can start easing. Well, why didn't they make that assumption when they had rates at 0 or negative and inflation was still below 2%? Why didn't they say, we've printed a lot of money, we've kept interest rates low for a long time, even though inflation is still below 2%, we're going to start hiking now because it's clear that inflation is going to go up, right? It's going to trend higher based on what's in the pipeline. No, they said we need to wait. And in fact, with the Federal Reserve, not only did they wait for inflation to be 2%, they said we want it to be above 2%. We want to make so sure that we're at 2% that we're not going to stop at 2%. That's when they introduced the concept too of inflation averaging. They wanted to make up for the years of sub 2% inflation with some years of above 2% inflation. But also, they said they wanted to make sure that the move above 2% stuck, that it wasn't like a fluke. Like we didn't go back above 2%, then come right back down. So they wanted to make real sure. They wanted to stay easier for longer just to make sure that inflation got to 2%.
Despite this setback, gold prices are poised to register their first weekly gain in 3 weeks. Market participants are increasingly speculating on the possibility of the Federal Reserve cutting interest rates soon. Such a move would likely lead to a decrease in both the dollar's value and Treasury yields. How do you believe the ongoing changes in central bank policies will influence the trajectory of gold prices in the upcoming months? Share your thoughts in the comments section below. If you found this video informative, please consider supporting our channel and turning on notifications to stay updated on our latest content. See you in the next video.